One subject I get asked about really frequently is lender's mortgage insurance, also known as LMI. So we're going to have a close look at it today. We want to know what is LMI, when does it apply, how is it calculated, and most importantly, how can you minimise or avoid it altogether. So let's get going. Lender's mortgage insurance is an insurance premium paid by the borrower, but it protects the lender against the risk that the borrower defaults and the lender doesn't regain all its money. Sounds pretty fair, right? The premium for LMI is charged as a one-off premium at the start of the loan, and it's paid by you, the borrower, even though it protects the lender. And I want to make the point that LMI shouldn't be confused with mortgage protection insurance, which is about protecting the borrower against the risk that they can't make loan repayments. So when does LMI apply? Well, typically banks are prepared to lend as much as 80% of the value of a property, and they don't want to lend more because of the risk of losing money. But lenders are prepared to lend you as much as 95% of the value if they can pass the risk on to an insurer. And this is great news for home buyers because it means they no longer need 20% to be able to buy a home. They can buy a home with a far smaller deposit. Now, lenders will arrange LMI for you as part of the loan approval process, so there's no additional paperwork involved. So how is LMI calculated? Well, the LMI premium depends on two variables. The first one is the loan amount, and the second one is the percentage that the loan amount makes up of the total property price. Let's look at an example. If a borrower bought a house for $300,000 and borrowed $250,000, they would be borrowing 83% of the purchase price. And the mortgage insurance premium would be $1,750. But if a borrower bought a house for $700,000 and borrowed $650,000, they'd be borrowing 93% of the purchase price, and the premium would go up to over $25,500. Now that's a massive difference. And no one enjoys incurring costs that really don't give them any substantial benefit. So the question's got to be, how can you minimise or avoid altogether mortgage insurance? Let's have a look at that now. You can minimise mortgage insurance just by understanding one key thing. Mortgage insurance premiums vary from lender to lender to lender. And the difference between the cheapest and the most expensive can be several $1,000s. Knowing that, when you go looking at loans, you now know you need to ask them what the insurance premiums are going to be and factor that into your comparison. As for avoiding LMI altogether, there are two ways we can do it. The first way is to save 20% of the purchase price. Now, I know that's easier said than done, so let's look at the other option. The second option is to have family go as guarantors for the loan. That means they'll put up one of their properties as a second security for your loan, and in this way, we get the loan amount under 80% of the total value of the securities. Now, it's quite a complex subject, so I'll look at it in more detail in a later Hatch dispatch. In the meantime, if you've got any questions about mortgage insurance, please give us a call. Our service is obligation and cost-free.